Welcome to the deep dive. Today, we're really getting into something that connects global power struggles, well, right down to your everyday life. We're talking about that incredibly tangled relationship between geopolitics and global oil markets.
Yeah, it's a fascinating connection. It doesn't just shape foreign policy debates, does it? It ripples through entire economies and it lands squarely in your wallet pretty much every time you fill up the
Uh,
car.
Exactly. And we've got this great stack of source material from you, our listener. We've got articles, research papers, even some personal notes, all focused on this. So our mission today, let's try to cut through some of that complexity. We want to pull out the most critical insights and really understand why this dynamic still matters so much for everyone.
Sounds good. We'll be looking at, the specific ways global tensions can make prices jump around, and the crucial lessons history teaches us about how markets adapt, or sometimes fail to adapt, during crises. Plus, the kind of the surprising situation in the market right now, and maybe what the future holds as the whole energy landscape keeps shifting.
Okay, let's dive in then.
Agreed. Let's do it.
So the first thing that really jumps out from all this material, even with all the talk about energy transition, renewables,
Mm-hmm.
is just how profoundly oil still matters.
Yeah.
It's clearly not just another commodity.
Not at all. The sources are really clear on this. Despite the transitions happening, oil is still fundamentally strategic. Its importance goes way beyond just economics. It's deeply woven into national security, geopolitical leverage, that kind of thing.
Right.
And because it's so sensitive to political instability, when prices get volatile, the effects aren't just limited to energy markets. It can cascade out, trigger economic slowdowns, really influence international relations. One note even called it an enduring determining factor in the economics of several production chains. I thought that captured its foundational role pretty well.
So it's not just about fuel for cars and planes.
Mhm.
It's embedded much deeper in how global industry and trade actually work.
Precisely. It's used across so many sectors. So any disruption or just big price swings, they get felt everywhere.
Mhm.
And that just amplifies its geopolitical weight, even as alternatives are gaining ground.
Okay, let's unpack this a bit more. How does geopolitical tension actually, make prices jump around like that? It feels like it's got to be more complicated than just, say, supply drops and price goes up.
Yeah, you're hitting on a key insight from the material there. It's not just about the physical barrels moving or not moving. Geopolitical tensions tend to exert influence through, well, three main channels and often all at the same time. There's the direct impact on supply, shifts in demand expectations because of uncertainty, and then, maybe surprisingly powerfully, market sentiment and speculation.
Okay, so starting with supply. Conflict seems like the most obvious driver there.
Absolutely. Direct disruptions are most intense when they happen in major producing regions. The sources often call the Middle East the epicenter of oil market volatility for good reason. Conflict there can instantly threaten production itself or the routes it travels on. And what's really critical, something the sources stress, and that markets often price in a risk premium even before a single barrel is physically lost.
A risk premium.
Yeah, like an extra $5 to $15 per barrel sometimes added just based on the threat of disruption.
Ah, okay. And this is where those critical choke points come into play, like the Strait of Hormuz you hear so much about.
Exactly that. That narrow strait is incredibly vulnerable, but it handles a huge chunk, something like 20–25% of the world's oil trade. A disruption there isn't just theoretical. The sources mention a specific period back in January 2025 where tensions related to Hormuz added something like a 12-barrel premium for about a month just because of fears around that route.
Wow, okay. What about the more indirect supply pressures, like sanctions?
Oh, sanctions are a huge piece of this, and they're really complex. When major producers like Russia, Iran, or Venezuela get targeted, it effectively removes significant amounts of oil from, let's say, the easily accessible global market. An IMS report highlighted in the sources noted that sanctions on just Iran and Venezuela took about 1.8 million barrels per day off the market. And that makes the whole global system much more sensitive to any other disruptions that might happen.
Does that sanctioned oil just disappear?
Well, not always. It often still finds its way to market, usually through more complex routes and at a discount. But the key point is it reroutes trade flows, it tightens the overall available supply, and that contributes to price sensitivity and volatility. We saw this with recent U.S. sanctions on Russia in January 2025, and there's ongoing uncertainty around Venezuelan assets that continues this pattern too.
Okay, so tensions mess with supply, both directly and indirectly. How do they hit the demand side?
Well, geopolitical uncertainty, it fundamentally clouds the economic outlook. People get nervous, businesses get nervous, and economic growth is directly tied to oil demand. So think about trade tensions. The US-China example came up a lot in the sources. Some modeling suggested a full-blown trade war could shave, what was it, zero point 0.5 to zero point 0.8 percentage points off global GDP growth?
And less GDP growth means less need for oil, right?
Precisely. That kind of GDP hit could translate to maybe 800,000 barrels per day. Less oil being consumed globally, less manufacturing, less trade, less activity overall. The sources explicitly linked the US-China tensions back in 2018-2019 to slower global oil demand growth during that time. It's similar when bodies like the IMF revised global growth forecasts downwards. They did that for 2025, lowering it to 2.9%, and that directly led analysts to lower oil demand projections. One estimate cited was a cut of about 400,000 barrels per day just based on that revised economic outlook.
Even though overall global demand is still projected to grow, mostly from emerging economies.
That's right. The underlying trend is still growth, maybe 1 to 1.5 million barrels per day annually. But factors like, say, China's growth being slower than it was pre-pandemic, that tempers expectations. Or conversely, you get seasonal spikes like the summer driving season in the Northern Hemisphere adding maybe 500,000 barrels per day just for U.S. gasoline. All these pieces are influenced by the broader economic picture, which itself is constantly being shaped by geopolitical events and anxieties.
Okay, this next part is where it gets really interesting and maybe less intuitive for a lot of people listening. It's not just about the physical flow of oil or even those direct demand changes. The sources put a lot of emphasis on market sentiment, on speculation.
Yeah, this is absolutely key to understanding the volatility we see. Markets trade on expectations, on fear, sometimes just as much as they trade on physical realities. So, perceived threats, even if they don't actually materialize into blocked shipments or anything, they translate into that fear premium or risk premium we talked about. Right now, the sources estimate the current risk premium in Brent crude, just from geopolitical concerns swirling around Iran, for example, is somewhere in the $5 to $8 per barrel range.
So just the possibility of a problem adds significantly to the price we all pay.
Exactly. And this effect is hugely amplified by, well, the financialization of the crude oil markets. It's not just oil companies buying and selling physical barrels anymore, not by a long shot. You have massive speculative trading happening, futures markets, and what the sources call managed money traders. MMTs, which are basically large hedge funds, investment groups, they're making huge financial bets on which way prices will move, often based on news flow, sentiment, geopolitical whispers.
And the data supports this.
Oh, yeah, the data is compelling. Some analysis suggests that the impact of this kind of speculation on short-run volatility, we're talking anywhere from a 3% to maybe even a 22% swing, can actually be larger than the impact of a physical supply shock. So these financial actors aren't just reacting to prices, they're actively shaping prices based on their perception of risk and opportunity.
That's a really crucial point. It's not just reactive, it's active price shaping. Are there other non-physical factors pushing prices around?
Yes, currency fluctuations are significant because oil is priced globally in US dollars, right? So when the dollar gets stronger, it makes oil effectively more expensive for buyers using other currencies. That can dampen demand and put downward pressure on the dollar price of oil. The sources noted a historical correlation. A 10% stronger dollar often leads to a 3–5% decrease in oil prices. They cited Q1 2025 as an example of this playing out. Rising interest rates also play a role. They can pressure prices down too, partly by increasing storage costs for traders holding oil, partly by reducing economic growth forecasts, which hits demand, and also by increasing borrowing costs for oil producers themselves.
Okay, so it's a really complex mix of factors. Let's turn to history now. You mentioned history provides crucial lessons. The sources make it clear that while this link between tension and price is pretty constant, how the market responds and maybe adapts has evolved over time.
Definitely. Looking back at the major oil shocks really shows us the raw power of these geopolitical links. But yeah, it also shows the development of what you might call shock absorbers and a certain amount of market resilience building up over the decades.
Okay, let's start with the big one, the 1973 Arab oil embargo. That was really a formative moment, wasn't it?
Oh, absolutely formative. Triggered by the Arab-Israeli war, followed by that embargo and production cuts from Arab OPEC members, the price impact was just dramatic and prolonged. It quadrupled from around $2.90 to nearly $11.65 a barrel. That's huge. It contributed significantly to a global recession, and it really hammered home the energy dependence of importing nations, especially the U.S.
And the response?
Well, that was foundational too. The U.S. really kickstarted efforts toward energy independence, or at least reducing dependence. And crucially, the International Energy Agency, the IEA, was created. That brought consuming nations together to coordinate on energy security.
Okay, then just a few years later, 1978, 1979, the Iranian Revolution.
Right, another major shock. Iran's production plunge took about 7% of world supply off the market pretty quickly. But what the sources really emphasize here is that the size of the spike prices more than doubled again, up to $39.50, was driven heavily by panic. Fear of wider disruption, hoarding by consumers and companies, it really demonstrated that sentiment layer we were just talking about. And this shock heavily fed into the stagflation crisis in the U.S., pushing inflation higher.
Moving ahead to the 1990-1991 Gulf War, that seemed to play out differently in terms of the market reaction, didn't it?
It really did. When Iraq invaded Kuwait, it instantly took significant supply offline. And prices spiked, sure, hitting $30, even $40 a barrel briefly, but then remarkably, as soon as the military response got underway, prices just plunged. They fell below $20 a barrel, actually lower than before the invasion.
Why the quick turnaround?
It showed that the energy security system built after the 70s crises was starting to work. Specifically, the coordinated release of oil from strategic reserves like the U.S. Strategic Petroleum Reserve, SPR, along with reassurances from other producers like Saudi Arabia. It proved effective at mitigating the immediate supply shock and calming market panic much faster. It showed an evolving capacity to respond.
Okay, let's fast forward to a much more recent crisis.
Yeah.
The 2022 Russia-Ukraine conflict.
Yeah, this was a major modern test of the system. Some sources described it as happening under exceptionally elevated geopolitical tensions, leading to, quote, sharp changes in oil prices. Sanctions directly hit Russian exports, although, as we discussed, complex rerouting did happen. But the sources cited estimates that actions by OPEC Plus helped cut the resulting volatility by nearly half. And releases coordinated by the IEA from strategic reserve cut volatility by another 20%. So it again showed the continued relevance of these coordinated responses in managing the immediate price fallout from a massive geopolitical event.
So if we look at the recurring patterns here, it seems like vulnerability to choke points and instability in producing regions persists. But the tools, the mechanisms to cushion the immediate blow, they've gotten more sophisticated over time.
That's exactly the key evolution the historical review highlights. The 1970s shocks were truly crippling, partly because the response mechanisms were, well, pretty nascent. Later shocks, while still painful, often saw quicker market corrections. You had the SPR, IEA cooperation, OPEC Plus acting as stabilizers. These shock absorbers were in place. And don't forget, high prices themselves spur longer-term adaptations, too. Things like increased production from places outside OPEC, think U.S. shale booming after 2010. Plus efficiency improvements and that gradual shift towards alternative energy sources. So yes, the vulnerability definitely persists, but the system's ability to absorb and mitigate the immediate shocks has certainly improved.
So bringing all this history and understanding of the mechanisms together, what does it all mean for right now, for 2025?
Well, it creates this really fascinating paradox, according to the material we looked at. On one hand, the sort of fundamental supply-demand outlook suggests potential oversupply in the market. That's because production outside of the main OPEC Plus group is expanding quite robustly, more oil coming online. However, despite that potential cushion, the market remains acutely vulnerable to geopolitical shocks. Very sensitive.
That does sound counterintuitive. Why is the market still so jumpy if there's potentially plenty of oil around?
It really comes back to that concentration issue, the concentration of critical infrastructure pipelines, terminals, shipping lanes, and the persistent instability in key producing and transit regions. So even if there's ample oil being produced elsewhere in the world, the threat of a disruption in a vital area, particularly the Middle East, is enough to keep that significant risk premium baked into prices and keep volatility high.
And the Middle East tensions, especially involving Iran and Israel, seem to be flagged in the sources as the most critical flashpoint right now.
Absolutely. That's highlighted repeatedly. Recent escalations, like an incident mentioned back in June 2025, can trigger immediate market reactions. That incident apparently caused an 8% jump in major oil company stocks almost instantly. So the fears of the conflict broadening, maybe impacting the Strait of Hormuz directly, those are very real in the market's eyes. Analysts cited in the material estimate there's a tangible $5 to $10 per barrel geopolitical risk premium currently priced into Brent crude, specifically because of these Middle East fears.
And if the worst happened? if there were a significant disruption in Hormuz.
The sources suggest that kind of scenario could easily push Brent crude up towards $100 a barrel, maybe even higher, depending on the severity and duration. Now, it's worth noting energy infrastructure itself hasn't been a primary military target, at least not systematically, in the most recent skirmishes. But the inherent risk remains high, and that's what the market is constantly trying to price in.
Beyond the immediate price spikes, what about the broader economic and strategic impacts of this sort of persistent volatility?
Well, the economic impacts definitely aren't spread evenly. Volatility and high prices tend to disproportionately burden nations that import most of their energy, especially emerging economies. And within countries, it hits lower-income households hardest as energy takes up a bigger slice of their budget. Within industries, too, it creates winners and losers, right? It affects investment decisions, planning. It creates uncertainty.
So what are the responses we're seeing strategically?
It's kind of a mix. You have the immediate crisis management tools deploying those strategic reserves, OPEC Plus, and the IEA coordinating actions when needed. That's the short-term firefighting. But underlying that, there's the longer-term strategic response that's gaining momentum.
And that's the bigger shift towards a different energy system.
Precisely. The sources really point to the enduring solution, the way to fundamentally reduce this vulnerability being a systemic transformation, accelerating the transition towards more diversified energy sources, less geographically concentrated ones, more domestically sourced power, primarily renewables. That kind of fundamental shift is what can truly, over time, alter oil's geopolitical leverage and reduce its power to cause these severe economic and political shocks around the world.
Okay, looking a bit further out now, say towards 2026, maybe out to 2030, does the outlook shift significantly?
Well, it's interesting. Despite the near certainty that geopolitical risks aren't just going to vanish, they'll likely persist. The general outlook from the sources seems to point towards a potential moderation or stabilization in oil prices in the medium term. The primary drivers expected to put downward pressure on prices are, one, that continued robust expansion of supply from producers outside the OPEC Plus group, and two, a kind of secular long-term deceleration in the growth of global oil demand.
And that slowdown in demand growth, that ties back to the energy transition we were just talking about. Efficiency, EVs, renewables.
It does, yeah. As energy efficiency improves across the board, and as alternatives like electric vehicles and renewable power generation gain more traction, the rate at which global oil demand grows is expected to slow down compared to historical trends. It might still grow, but slower.
So these bigger structural shifts, more diverse supply, slowing demand growth, they might increasingly act as a kind of ceiling on prices, potentially changing oil's traditional role.
That's the really fascinating conclusion some of the sources are drawing, yes. These underlying structural dynamics may increasingly limit how high prices can spike or for how long. It could potentially diminish oil's traditional role as a primary geopolitical weapon or as a source of those really severe economic shocks, maybe over the coming decade, even if those immediate short-term risks definitely remain.
Wow. Okay, we've really covered a lot of ground here, drawing from all that material you provided. We've seen how oil's strategic importance, well, it persists. The complex ways geopolitics drives volatility supply, demand, and, crucially, that layer of speculation and sentiment. Then the vital lessons from history, showing how resilience has evolved, even if vulnerabilities remain. And finally, this current paradoxical market situation, potential oversupply rubbing up against acute geopolitical sensitivity.
Exactly. And I think the key takeaway is that while those immediate shocks, especially in critical regions like the Middle East, remain a very real threat that the market is constantly grappling with and pricing in, it's also essential to recognize that bigger, longer-term structural shift that's underway. It's driven by changing supply dynamics like more non-OPEC plus oil and that decelerating demand growth linked to the energy transition. These forces are genuinely reshaping the fundamental market picture for the medium to long term.
Understanding this connection, this whole complex interplay, it really helps you, the listener, navigate and make sense of global events when you see them unfolding. It helps interpret economic news and see the strategic thinking behind energy policy debates happening all around the world.
It truly does highlight that intricate dance between economics, global politics, and the physical resources that, well, still power so much of our world.
So here's maybe a final thought for you to sit with after this deep dive, something to mull over. Given this continued vulnerability we see to sharp, short-term geopolitical shocks, especially in those critical regions, despite the longer-term trend pointing towards potential price moderation driven by the energy transition and growing non-OPEC plus supply, How will this fundamental paradox, short-term risk versus long-term structural change, actually influence the strategic decisions made by both energy producers and consumers in the years ahead? Will that short-term risk constantly override the longer-term trend?
That's a really critical question, I think. A key uncertainty for anyone trying to navigate the energy future.
Definitely something to keep exploring, keep thinking about these connections. We really appreciate you joining us for this deep dive today.